So I think the GDP report was a pleasant surprise. We were at 2.5% growth, which, given the context of 1.3% last quarter and 0.4% the quarter before, is certainly good news. And the components, the sources of the growth was very encouraging. There was strong consumption and strong business investment. But I have to say the optimism or the reading this as good news is in the context of how bad things have been recently. 2.5% growth from a post-World War II standard is not very strong. It's probably a little below average, and it's certainly far below what you would expect coming off of a weak recession. So recovery we should be seeing growth over 4%. So I view it as that it could have been a lot worse news, and this was better than expected. And one hopes it bodes well for the future. But it's still, we're still seeing a very weak recovery. This is essentially where we were about a year ago. We were seeing about 2.5% growth. Not enough to really make substantial gains in our unemployment situation, which I think is the pressing problem of the day, but certainly better than we were earlier in the year. I don't think this puts to rest concerns about a double dip. It certainly alleviates it. If you go back to August and September, coming off of the very difficult debt ceiling debate, which was not good for the economy, and coming off the drop in confidence that ensued, there was a lot of concern among others that we have a substantial risk of a double dip. This certainly makes it seem better that all that was happening in the third quarter, and now we see third quarter was actually better than expected at 2.5%. But I can't be too sanguine about our future in the near term. You still look at the housing market, which, as I said, is in a depressed state. It's not detracting from GDP, but it's not contributing much either. The labor market is still in really a dismal shape, and you worry about what that does to consumer confidence and going forward. And essentially, one way to look at it is we're still kind of prone to shocks. How does Europe resolve? What's the next shock that can kind of disturb the economy and cause a hit? It's hard to feel too confident. Certainly, it's better than expected, and growth is good. But I think that we still in kind of precarious times. Well, I think tax reform is a key issue, and I think the next administration, whoever that would be, whether or not it's a Democrat or Republican, it should be high up on the agenda. We have an extremely inefficient tax system. It's at times unfair. It's very confusing. It creates uncertainty. There's really not much to like about it, and so the optimist in me says, well, there should be a lot of room for improvement and even compromise and moving forward. The one thing I would like to see, and I think is essential, is if you're going to be looking at tax reform, you really need to be looking at it in the context of a broader fiscal reform. The Simpson-Bowles Commission did that, I think, very well, and unfortunately, I think the Perry plan this week didn't do that. It's one thing to talk about tax reform and lowering taxes, and there's lots of good arguments for that. But if you're going to be lowering the amount of revenues we get from the tax system, you really need to have a very strong and credible plan for how we're going to pay for what our current commitments are. And if we don't have enough revenue, how we're going to get those down. And that's really, we don't need all dessert, we need spinach also. And unfortunately, we haven't seen a lot of that. Again, the commission, the Simpson-Bowles commissions did do that, and I think it was a great starting point. Unfortunately, it wasn't embraced widely enough to move forward. But I think that's a key component for the next administration.